Hello friends, this is Dr. Amarjeet Kaur, Professor of Accounting and Business Communication at the Department of Management, Gurugram University, Gurugram. So friends, we will continue with the scope for a few minutes and thereafter we will talk about the financial management process, how scope is connected with the financial management process and how other disciplines are connected with financial management other than importance of financial management. So this is the agenda for next few minutes. So if we talk about the modern approach of financial management, it talks about three aspects of daily use in the business. Number one, it talks about investment decisions. Number two, it talks about financing decision, and number three, it talks about dividend decision, right? So three decisions which are taken as part of scope of financial management basis on the modern approach of financial management. So question comes in, what is investment decision? So investment decision basically is the decision which refers to selection of assets, right? Where should I invest in? As a finance guy, I should invest in X project or Y project, X machinery or Y machinery, X product or Y product. So this decision is taken to invest the funds in long term assets. So then we call it as capital budgeting decision. And when this decision is taken to invest in short term assets like raw material, like inventory or like debtors, etc., then it is taken or it is known as working capital management, which means investment decisions comprises two aspects into it: capital budgeting decision, which belongs to investment in long term assets, for example a plant, a building, a machinery. And the second part I said is working capital management, which is inventory, primarily raw material, or finish, or semi finished goods or finished goods if I am a trading company, or putting money into debtors, that is also work asset, right? So working capital management. So this is the investment decision. So what is financing decision? It is it indicates the possible sources of raising finances from various resources, and it is related to the procurement of funds required at the right time. So it involves selection of the best and cost effective method for financing. So basically financing decision is limited to the procurement part as well as selecting the right source of the funds. So the traditional approach, when we talk about the scope, so traditional approach of financial management was limited to this function only, the financing decision function only of the financial management. It was not considering investment or dividend decision. But what are we doing in this decision? We are analyze, first of all we are gathering what are possible sources of funds to me. For example, all the companies cannot raise funds through debts, right? All companies cannot go to raising equity even. So as a finance guy, it depends what kind of company I am in, I am working in, what is the age, what is my legal standing, can I raise funds through debt, can I raise funds through term loan, etc., etc. So we will explore possible sources and then we will gather and analyze the cost of each source. For example, getting loan from X bank could be 10%, other bank could be 11%. Within the same type of source of funds, I mean the bank loan or the term loan, the rate of loan could be different, right? So here we analyze possible sources of raising funds. So where I can procure funds. And then finally this function, this decision involves selecting the best and the cost effective method for financing. By after comparing, after doing the analysis, we can lead to, or we can go to the best possible source which is cost effective, which is giving us minimum risk of insolvency, and is also cost effective, is considered to be the best source. So we need to select the final source of financing under this financing decision of the of the financial management. The third decision in financial management is dividend decision. Now, this decision involves distribution of the net profit, which financial manager makes decision regarding how much dividend is to be paid out of how much to be retained. It's just not that so whatever you have earned is enough. You have earned and your job is done. You made company earn X amount. But what about the money which you have in your hand, right? So here, as a finance manager, your job is to look into the distribution aspect as well, because these financial decisions are going to finally affect the your shareholders wealth. So look at this slide which is there on your screen. This we call it as financial management process, which includes both financial planning and control, because this is what the modern approach say. So if you look at the first column, it is talking about financial decision, the ones I just talked about: investment, financing and dividend decision. So what are they affecting? If you look at the arrow is indicating that these three decisions, they affect the risk and return characteristics of the firm, right, which in result is affecting the market price of the share, and ultimately the end result or end effect is on the shareholders wealth. So which we denote as W. W denotes for shareholders wealth, which is equal to N into P, right? P is on at any point of time P0. So P is the price of the share at given point of time, N is the number of shares. So N into P is your wealth, which is equal to W, which is wealth or shareholders wealth. So how the wealth is decided or affected? The wealth is affected by the price of the share. In this formula, N into P, P is the price of share, and as per the conceptual framework here, the price of share is affected by the risk and return characteristics, how my company, how my firm is perceived, how risky or how safe my company is perceived in the market, and how good or bad it is perceived for returns. So these two characteristics, risk characteristics and the return characteristics of the company, they decide my price of the share in the market, right? So this is a great connection between, and how my risk and return is being decided. This is decided based on the three decisions, and who is taking those three decisions? The finance guy is taking those three decisions, right? Investment, financing and dividend decisions are the purview of the finance manager or controller of the finance. So it means these three decisions are of ultimate importance, because they are going to affect the shareholders wealth, and that is the ultimate thing, that every company wants the share price to be very high, and shareholders wealth is automatically going to be high, because P is one of the product, like one of the variables which is the product to N, right? So that is how the whole financial management process is connected and affects the shareholders wealth in total. Okay, so now we will talk about these decisions, how they or how this whole financial management process, planning to controlling everything, is important for the in management, for financial management function. So number one, there are a couple of points I am going to discuss. Number one, the financial planning, it helps in financial planning. Number two, financial decisions and controls. Number three, cash flow management. Number four, capital management. So these are the 4 points of importance regarding the importance of financial management. So let's take the first one, financial planning. How does financial management helps in financial planning? So if you remember, in the scope we discussed that as per the modern approach, this is the responsibility of finance guy to assess that how many funds would be needed in future, both for long term investment or for short term needs, be it salary or be it insurance or rent or day to day expenditure, be it toilet paper for that matter, right? So that's what the financial planning is, that we need these many funds and this is how we are going to procure them and utilize it. It's financial planning completely. Number two, the financial decisions and controls. So, financial planning leads to deciding about the investment to be made, about the financing to be made, about the dividend to be distributed, and that is with these three decisions, we are exercising control on these aspects of financial management, right. So the control becomes more effective because we are following a financial management process, tools and techniques. We have couple of tools and techniques which help us decide about the investment, financing, etc. There are so many softwares available nowadays, right. So these tools, techniques, processes help, which are the part of financial management, which comes under the purview of financial management. They help us decide or exercise better control. Then not only that, effective cash flow management is possible because of the financial decisions which are taken effectively by the finance guy. So cash flow means when do we expect the funds to be received, to be released for various purposes. So that all is cash flow. So inflow and outflow, cash outlay for project, cash outlay for salary, everything is been taken care under the financial management. So that is the importance of financial management, that it does take care of this aspect. Then not only the cash but the capital management. Capital is the funds which we receive from investors, equity holders. So the best use of those funds is important. Capital, for the layman's, capital could be also the funds which have been procured through debts as well. So if we take, how to maximize the return on the capital which has been invested by shareholders or by promoters, right. So capital management becomes effective through financial management function, because we have tools to assess, we have time value money concept, we have risk and return assessment, we have risk adjustment factors available. So we use so many techniques or such techniques to utilize the available capital to the best. The fifth point is risk management, sixth point is financial reporting, and the seventh point is disposing of surplus. This is also the importance of financial management, that it works in the area of risk management. So there are so many kinds of risk, be it business risk, be it financial risk, be it interest risk. Risk means expected deviation or the deviation from the expected outcome, right. How much is the deviation which will happen for payment of principal money or interest, how much possibility of variation or deviation is there during a quarter for inflation or foreign exchange rate on my expected inflow of funds, etc., right. So this is what is being done and looked after under the financial management, and this is the importance of financial management. It does take care of the risk, be it business risk, be it financial risk, be it any kind of risk. So we incorporate risk factor, we discount all the inflows and outflows basis on the risk involved in different projects, and then we bring all the inflows and outflows at a comparable level, and then we decide. So our decision making becomes more effective if risk component is incorporated in the total management of funds. The financial reporting part is also very important, and especially for public limited companies. So nowadays it's not only the accountant who prepares financial statement. We have a CFO who looks after reporting aspect as well, because if you remember a few minutes ago I discussed that these financial decisions, be it investment, financing, dividend, they decide the risk and return characteristics. How does the market get to know about these decisions? Through the reporting, through public reporting, and now there are management discussion sessions. When I say reporting, doesn't mean only the balance sheet and the profit and loss account. I do mean the management and discussion section, MD section as well. I do mean many annexes. I do mean environment reporting. I do mean so many more aspects of reporting than just the balance sheet and the statement of profit and loss, right? And those are even the subjective statements in the financial reports. They send a signal, they send a message in the market. let's say there's something in the MDA, it is talked, the company promoters or the company or board of directors signed, executive director signed that or wrote that company plans to expand. This is an opportunity we are, or a carrot we are showing to the investors, right? Isn't it? So that's financial reporting. So that is also important, and it is to be, and that's what has been affected by, that is also the importance of financial management. That financial reporting is also taken care, and it leads to the shareholders' wealth, maximization. Last point was disposing of surplus, which means the dividend decisions, which means that the financial management do decide about, should we retain the profits as it is full amount, or should we partially dispose of in dividend form and partially retain it, or to distribute the complete money, right? We have so many cases where companies retain money or retain profits for years, and then finally they distribute it in a huge bonus, because whatever the purpose of retaining those profits was, that was not allowed due to some legal legal causes or purposes. Or it could be other way, you couldn't expand, you intended to expand, you intended to enter into a particular market, and there was sudden ban, so you had reserved profits with you, which you distributed, right? So disposing of surplus is also an important decision in the financial management, and since we do it with the help of techniques and tools and models are there, we have couple of models being proposed in dividend policy as well. So this becomes important and effective, and this is one of the importance of the financial management, that it does help us in deciding how to dispose the surplus. These were the points under importance of financial management. So now I would like to talk about finance and other disciplines, how they are connected. So have a look at the slide in front of you. So there are certain financial decision areas. So primarily we have three areas only. If you look at the three areas, we have investment analysis, we have second is the financing, and third is the so if you look at the first column I am referring there, and third is dividend decision. So in the investment analysis, we have working capital management, we have source and the cost of capital, and then in the we have determination of capital structure, we have dividend policy, and we have analysis of risk and return. So investment decisions are long term investment as well as the working capital both. So these are the different function, primarily areas or decision areas in financial management, and which are the disciplines or domains which support financial management to take these decisions effectively. So if you look at the right hand side of the slide, so primary disciplines which help or which support financial decision areas are accounting, microeconomics and macroeconomics. I will discuss how do they do that. And in other which are related or allied areas or disciplines are marketing, production, quantitative methods, and they all together affect the shareholders' wealth, right? So now let me explain this model to you. So three areas which are taken as decisions in the finance. Now in investment, we have already discussed, we have two aspects to investment decision. One is to decide that how much to be retained in working capital, which is basically current assets and current liabilities, if I talk about the net working capital. And the second aspect is the long term investment, be it building, be it machinery, be it project, etc., etc., right? So how much should I invest? We carry an investment analysis, and then this is been carried in two aspects, for working capital and for the long term investment. Why? Because working capital is, when we retain working capital, means it includes cash as well. So my liquidity would be very good, right? Because I have good marketable securities, I have a good amount of cash in bank or in locker, or I have maybe good amount of debtors, good amount of bank balance. But point is, more liquidity or more investment in current asset means less return on that money. and vice versa. More investment in long term, the long term investment has a higher rate of return, whereas but less risk, whereas the working capital investment has low risk if we keep the money in liquid form, but higher we have higher liquidity but less risk. So there is an inverse relationship here, liquidity and risk. So it's a difficult decision, because if you are having shortage of funds, you do not retain money for day to day operations, you just rely on the inflow of the money, and suddenly something like corona happens, the government shuts down all the banks, all the bank operations are done, you have yet to pay the salaries. What will you do? You didn't retain any money for the basic requirements, right? This is an extreme situation, but I'm just giving an example. So this is the decision which for where we carry investment analysis, then the source of the capital and the cost of capital both, and then deciding that within those available sources, how much percentage of funds to be used from X source, how much to be used from the Y source. So that is what is taken as or known as capital structure, the composition of debt and equity, and within the equity, within the debt, various sources are there. Okay. So this is the second aspect of decision, and of course the third aspect of decision is dividend policy. One rider which actually takes care of all the three decisions which have been discussed in detail is risk and return analysis, right. So these are the decision areas which are supported by, first of all, primarily by accounting. How come? Accounting data is constructed, is been developed, is been created by the software throughout the financial year by collating data under certain heads and for reporting purpose. So accounting gathers financial data as an obligation, as a requirement, and that is how accounting helps the financial management guy to take care of these different decisions. So accounting is the primary area, because we are getting the value for different cost heads, we are getting the values for revenues, we are getting the values for cash, expected cash flows or inflow outflow both, we are getting values for all expenses, all different heads. So accounting is the primarily area discipline which helps finance area, financial management area. And how does microeconomics and macroeconomics? So these are the three core areas which help us. Microeconomics and the principles of micro and macroeconomics are applicable on decision in financial management. How come? Take the most popularly known principle of supply and demand and supply, right? So if demand and supply rule is known to the finance manager, finance controller, he knows, he would understand how would it affect the exchange rate if there is a higher demand for dollar, for example, in during a particular year of day of the year, or during a particular quarter of the year. I, as a finance guy, would be able to apply the demand and supply rule. If there is a higher demand during a particular period or duration or season or festival season, I would know that if demand is higher, supply remains same, the cost will go up. That is how the exchange price for foreign currencies is affected, right. Micro level economics rules, so many of them, macro levels, many more economic theories and concepts are applicable, and they are adopted by the finance guy, and they are used in financial management as processes, as techniques, right. So this is the primarily accounting, micro and macroeconomics area. Other areas like marketing, other area like production and quantitative methods, they also support the financial decisions, the discipline of finance. How come? Marketing guy, they need to make marketing budgets, they need to assess they need to carry the market research, they need to carry the assessment of demand of the products, and basis that the production guy will decide the schedule of the production, will decide how much to be produced, how many units to be produced also taking care into the inventory policy of the company, and that decides in turn of the in production guy's report will help the procurement guy to decide. So what is happening? I as a finance manager, my job is to ensure working capital. Working capital for raw material, working capital for salary. Here the marketing guy will let you know, the production guy will let you know the cost then they are going to incur, the revenue they are going to generate, etc., etc. These disciplines, their theories of marketing, the concepts of marketing, concepts of production are going to affect the financial decision. And certainly the quantitative techniques, statistical methods, we use many statistical methods, be it regression, be it correlation, in deciding many things, in deciding many decisions of finance. So these are the primarily as well as other allied areas which helps us financial management, and ultimately the ultimate effect of this decision is on maximizing shareholders wealth, which is also taken as objective of financial management. So friends, I hope you were able to gather a clear idea, clear understanding of scope of financial management, importance of financial management, and how financial management is connected with other disciplines, and including how does the financial management decisions affect the shareholders wealth at this whole process. So I with this I would like to sign off. Thank you very much friends. Thank you.